Hey everyone! So, while you were probably busy with last-minute holiday shopping, the stock market gave itself a gift, a brand new all-time high on Christmas Eve. But is this just some fleeting holiday cheer, or is something bigger going on? Let's dive in and figure it out. And there it is. That's the magic number, 6932.05. That is the new record closing high for the S&P 500. It all happened during what Wall Street loves to call a Santa Claus Rally. So the big question is, how on earth did we get here? And more importantly, what's next?
All right, first up, let's unpack this new market record. We're going to get into the numbers behind this holiday surge and see what's really moving the needle.
Okay, take a look here. The S&P 500, the Dow, the NASDAQ, everything's in the green. It was a pretty broad-based rally. But honestly, that's not the most interesting number on the screen. Look down at the VIX. That's the market's fear gauge, and it's down almost 4%. That tells you that investors are feeling really confident, maybe even a little complacent heading into the new year.
So what is this Santa Claus Rally I mentioned? Well, it's not just a cute name. It's a real historical trend where the market just seems to get a burst of energy at the very end of the year. And so far, this year is following that script almost perfectly.
But listen, this isn't all this holiday spirit and seasonal trends. No, this rally is built on a foundation of some seriously strong economic data. Let's talk about the two key drivers that are really powering this whole thing.
Check this out, 4.3%. That was the annualized growth rate for the U.S. economy in the third quarter. To put it simply, that blew expectations out of the water. When the economy is growing that fast, it gives investors a ton of confidence to put their money to work.
Now here's the other half of the story, and this is what makes it so powerful. While the economy is growing strong, inflation is showing signs of cooling down. You can see it right here in the bond yields. They're all falling. This is what economists and investors call the Goldilocks scenario. The economy's not too hot, not too cold, it's just right.
But you know how it is. Even when the overall market is hitting records, there's always drama happening with individual companies. It's not all smooth sailing for everyone. So let's look at the specific winners and losers making headlines.
So in the winner's circle, you've got Nike jumping a solid 4%. Why? Because Apple's CEO, Tim Cook, just doubled his personal stake in the company. That's a huge vote of confidence. Then you have UiPath absolutely soaring over 7% because it's being added to a major S&P index. But it wasn't a great day for everyone. Tesla and Netflix both took a hit after analysts downgraded them, basically saying their stocks have gotten too expensive.
And let's not forget about Merck. The pharmaceutical giant is getting a lot of positive buzz from Wall Street. You even had Jim Cramer come out and flat out say, Merck is a cheap stock. Now that's interesting because it could be a sign that investors are starting to look for value in sectors like pharma, which have kind of been left behind this year.
Okay, so we've covered the macro picture and the individual stock stories. But the question you're probably asking is, what does this all mean for me, for my money? So let's talk strategy and break down what your next move might be depending on your style.
If you're a conservative investor, the name of the game is discipline. With the market at a record high, now is the perfect time to review your portfolio and rebalance it back to your long-term targets. This is not the time to chase high-flying stocks. Stick with your plan, high-quality companies, dividends, and bonds.
Now, if you're more of a moderate investor, this is where things get interesting. You might want to start looking for opportunities in those sectors that have been overlooked, like pharmaceuticals. Remember Merck? Pay attention to what the big insiders are doing, like Tim Cook buying Nike. And definitely get ready for earnings season in January. Just be selective, especially with tech.
And for all you aggressive investors, now's the time to be tactical. You could play the short-term momentum and ride this Santa Claus rally into the new year. Or you could look at big, long-term themes like AI and automation. A company like UiPath fits right in there. But remember, with the VIX this low, things can get bumpy fast. It might be smart to start thinking about hedging some of that risk.
So the big question is, what's next? What happens when we turn the page to a new year? Let's look at the key events coming up that will really test whether this rally has legs. January is going to be a minefield of market-moving data. Right out of the gate, we've got the jobs report. A week later, the all-important CPI inflation data. Then, companies will start reporting their fourth quarter earnings. Each of these events is a major test for the market's current good mood. Which brings us to the ultimate question, doesn't it? Is this incredible run-up a genuine sign of a strong economy and a great year ahead? Or is this just a really, really good year-end party before the hangover of reality kicks in?
Look, navigating all these twists and turns can be tough.
If you want clear, actionable breakdowns of what the market is doing and why it matters to you, that's exactly what we do here every week. Make sure you hit that follow button so you're always in the know. We'll see you next time.